Hello there. My name is Chris Cook. I work at Numera Analytics. I'm here with Joaquin Kritzlara, who is our head strategist. Welcome, Joaquin.
Thank you, Chris.
So less than 2 weeks to go, and we've got the elections. Obviously, this is something that a lot of our clients have been talking about. I thought today we'd talk about, obviously, we can't forecast what's going to happen. It's such a tight race right now. In fact, they're saying it's one of the tightest races in a long time. But instead, we do some scenario analysis on a potential Trump win or a potential Harris win. And in fact, this conversation is on the back of a report that we just came out with that we've been sending to clients. And that's really hit a nerve, definitely. So the way I think we should go about this is kind of look at their potential policies that they want to push through. Again, pushing these policies through are probably going to be difficult depending on if they win the House or they win the Senate or they don't win and so on. So there's probably a low chance that they're going to be able to push everything through. But I was looking at, so the four kind of categories we're looking at are fiscal policies, tariffs, immigration, and housing. So why don't we start with fiscal? Just to summarize, from Trump's perspective, we'll start with Trump. He's looking to extend the TCJA permanently. Obviously, this is some tax cuts that he brought in during his first term. He's looking to institute some tax cuts on the corporate side as well. So I guess the big question is, doing this, is this inflationary or not? We can talk about Harris after that.
Yeah, look, I think in thinking just in general about the various sort of agendas that you mentioned, regardless of whether it's fiscal policy or immigration or tariffs, what I think is really important is to understand the context in which this is occurring. And it's happening in a context in which the U.S. economy is, by many measures, still overheating. It's true that the Fed has started cutting interest rates as inflationary pressures have gone down. But if you look at the strength of the economy, you're at full employment, and activity and consumer spending in particular is rising well above potential, or certainly well above its historical long-term trend. And so when you start instituting measures that would, involve, say, either tax cuts or, in the case of Harris, an expansion in spending that would widen a fiscal deficit that's already significant, right? I mean, the U.S. has a primary deficit that's very large relative to other major developed markets. If you look at the deficit as a whole, of course, part of it is just interest expenses from rising interest rates, but in general, the government is spending more than what it's generating. And so if you go ahead with things like tax cuts, for example, or an expansion in spending, what would result from this would be the economy would hit its capacity constraints very quickly, right? And so that would create upward pressure on prices because, again, demand is already very strong. It would probably contribute as well to some degree of strengthening of the economy. The issue is that when you're already running at full employment, the contribution that tax reductions or an increase in spending can have are limited. Economists talk about sort of multiplier effects. The multiplier effect on activity would not be particularly high. Like in our simulation work, what we find is from these tax cuts that Trump is suggesting, so the extension of the TCJA and some moderate reduction in corporate income taxes, you would see a moderate boost to activity. It would probably add like 10 or 20 basis points over a baseline for growth. And the same thing, perhaps a little more for inflation. And just so we're clear, all of the simulations are done relative to our baseline. And so for inflation specifically, which is sort of the focus area today, absent any major any disruptive economic policies that would significantly alter the baseline, what we expect is for headline inflation to remain roughly near target over the next couple of years, eventually perhaps dropping towards the lower end of the target by mid-25 or late 25 as the job market loses a lot of its momentum.
Good. And then from Harris's perspective, she's probably again, it's not 100% clear, but probably looking to increase taxes on the wealthy, probably decrease taxes on the low income side of things. So at the end of the day, it does look like spending would be going up from her perspective as well.
Yes, exactly. And I think one thing to consider there, I mean, beyond the effect on inflation, is that if the deficit were to widen more than what it currently is at, that could create worries around fiscal sustainability, which basically for bond investors, what it means is that the risk premium on long-term yields would probably widen in the same way that they widen for any country whose currency is not a store of value, right? If there's worries around fiscal sustainability, then, you know, people demand an insurance for holding what previously was considered a safe asset, right? And so what this means is that even if the Fed continues to cut, long-term yields in that context may not fall as much as you would otherwise expect because of that effect.
So just to summarize, more inflationary from Trump?
Yes.
Trump policies?
Yes.
Okay.
Yes.
Tariffs, obviously, that's a real sticky point. From Trump's policies that he's pushing forward, two components. One is a 60% kind of flat rate on any Chinese good, which is different than what is currently in place and what he pushed through his first term. But I think more extreme is more effect would be the 10% at a minimum on every good coming into the United States.
Yes, exactly. That's right. When assessing the effect on tariffs, we do have some blueprint, right, from the experience of the U.S.-China trade war in 2018-19. To be sure, we're talking about a different magnitude of tariffs here than what we saw at the time. Remember, in 2018-19, the Trump administration levied, I think it was they started off with a 10% tariff on some Chinese goods, then they raised that to 25, and then there were a few other categories that were targeted. Steel, I think there were some appliances. Was it perhaps, I think it was washing machines or something that was targeted, but it was a lot more limited. Yeah. Right now, this is sort of a blanket tariff, what he's suggesting. They're both, you know, in principle inflationary, again, especially because of the current state of the economy. In 2018, if you look at just the evolution of not just headline inflation, but in particular imported prices or producer prices, which you would think would have been more affected by this, on net, actually, inflation fell since the Trump administration started enacting tariffs 1 year out, right? So between the start of 2018 and the beginning of 2019, actually the inflationary pressures diminished. Part of the reason for that was that companies that were imported parts just substituted towards cheaper alternatives. The strength of the economy was not the same as what it is today. And so the pass through onto final consumer prices was just perhaps not as pronounced as you would expect today. And just, again, the sheer magnitude of the effects were more modest. You mentioned these two types of tariffs. The 60% one on China sounds obviously huge. What's important here to consider, though, is that imports from China make up actually a very small share of the consumer basket. It makes up, our economists are calculating, it's about 2% of CPI. Remember, CPI in the US is very tilted towards services for starters. And then even goods themselves, there's a lot that are produced domestically. And then it's not just China that supplies these as imports. There's, you know, goods are coming in from Europe, they're coming in from Canada, from Mexico, from South America, whatever, many other places, right? So a 60% tariff would create a problem. The biggest issue is the 10% blanket tariff across the board, right? Because that gives no margin for substitution, essentially. Right. And in a context, especially if you were to pass it on immediately, right from the get-go, where the economy is still very strong and consumer spending, you know, basically it's overheating, that would allow importers to pass on, basically the markup would be quite high, probably. And so what we find is that the combination of these two tariffs, but particularly the 10% one, could lift inflation above the baseline as much as 1% over the baseline, and the peak effect would be in 2026. Now, importantly, though, we do still expect the economy to gradually lose momentum, for growth to be weaker than what the consensus is right now. And so eventually those pressures would dissipate. So it wouldn't be a permanent effect on inflation. By 2027, we find that most of that effect would dissipate. But certainly in the second half of 25 and in 26, this would certainly create a challenge for the Fed because, you know, a 1% boost over baseline is considerable, clearly.
And by the way, I will ask you what this all means at the end of this conversation for the Fed. Does it change the Fed's path and so on? From Harris's tariff policies, I think there's not much to say. It's not 100% clear. I think she's just going to follow what Biden's been doing over the last 4 years. So immigration. This is obviously a contentious subject. From Trump's perspective, I think everyone knows that he's been talking about this, you know, this 11 million potential deportation of immigrants. It's well, a couple comments on that. Obviously, will be very difficult to do. It's going to be very costly as well. But from an inflationary perspective, it sounds like it could be very disruptive. In fact, if you just look at it on a sector basis, just the healthcare sector employs something like 350,000 undocumented immigrants. Pulling that out would be very disruptive in an extremely tight job market. Same thing in construction. It applies through different sectors. So what are your comments?
So other than the 10% tariff across the board, we find that this policy would probably be the most inflationary. The key thing to consider here is that undocumented immigrants make up a significant chunk of the growth in labor supply in the economy. There's estimates from this by a variety of government bodies. The CBO in particular has they've been focusing on this quite a bit over the last couple of years. What they find, again, there's margin of error here, but they find that roughly at least 2/3 of the growth in labor force participation in the US since 2023 comes from growth in undocumented immigration, right? So even if you were to remove that as a source of support to labor supply, forget about sort of reversing the effect as you deport people, that would probably create significant inflationary pressures in a market that's already quite tight, right? So the effect here would be twofold. What we're like in the scenario analysis we built, we're not assuming that the deportations would be 11 million people. That's very aggressive by historical standards. We're assuming a fraction of that. I think it's like a third or 25% we're assuming. But even if you take that number, you would get it's a 40 to 50 basis point increase in inflation over the baseline, just that effect. But in addition to that, and this is important, because you're basically reducing labor force participation growth, that would probably tone down the unemployment rate. Part of the reason why the unemployment rate in the US has gone up in the last year has been through an expansion in labor supply. Typically, undocumented immigrants, when asked whether they're fully employed or not, they tend to underreport this. And so if you're removing these people, then probably the unemployment rate number would be lower than it would be otherwise. And so for the perspective of Fed policy, again, this matters, not just because it affects the inflation path, but also the speed at which the job market were to cool or the unemployment rate were to rise. So that I think is also important.
So from Harris's perspective, she's kind of dodging the question on immigration and talking more tough about border control. So I think it's basically a wash from an immigration perspective for her. So the last one is housing. We'll start with Harris. She's got the big plan, aggressive plan of looking to build 3 million homes in 4 years.
Yeah.
And from Trump's perspective, not clear. He's looking maybe to diminish regulations on construction. And so let's focus on Harris. And first of all, the ability to be able to do this is probably double.
Well, yeah, exactly. That's it. I mean, this would be a very sizable increase in housing supply. It would result in much faster growth in supply than we expect in our baseline for that concept. I'd add, it's not just sort of building affordable homes. She also wants to provide subsidies to
Right.
first-time home buyers. The subsidy aspect is just inflationary, right? Because it encourages demand for credit. The housing supply angle, though, is very important, essentially because of the importance that shelter plays in the consumer basket, right? So shelter, which is, again, not housing prices. Housing is an investment good. It's not a consumer good, so it doesn't fall under CPI. But shelter and the cost of so rent and the cost of maintaining a home, that does fall under CPI. Combined, those make up close to 40% of the consumer basket. And in the last couple of years, that has been by far the most sticky component of inflation, basically because those numbers are influenced by people's perceptions around their ability to sell their house, essentially. And because there's no housing inventory right now in the US, so if you look at any measure of availability of new homes, that's or new or existing homes, that's very low by historical standards. That's putting upward pressure on housing prices and keeping shelter inflation elevated. So if Harris were to put on these alternative measures where she would expand the availability of housing, that would have the reverse effect. And what we find, importantly, is that even if she were to pass a portion of that, I agree with you, getting that amount of new homes built may be challenging for her administration. But even with a portion of that, that would create sufficient deflationary pressures on shelter to offset any kind of inflationary increase from her expansion in fiscal policy. And so on net, basically, what this means is that if Harris were to win, the net effect on inflation would be close to zero, right? So it wouldn't really create much deviation from the baseline. So it's really just under Trump, and assuming that Trump passes on all of these policies we're discussing immediately, that you would get a situation where potentially inflation would be quite a bit higher than you would expect otherwise.
Right. Okay. So to conclude, let's start with Harris. Net effect of the four different important policies on inflation is
close to zero.
Okay. So basically we stick with our baseline from a Fed perspective as well. The net effect on Trump is?
No, that's much higher. With these scenarios that we discussed, we find that, again, if you were to pass on all of these policies immediately, and that's a big if, right? Then the baseline would shift to an alternative of 3.5% inflation in 2026, I believe, which is where it peaks. Yep. In addition to that, the unemployment rate under Trump rises by, I think it's like half of what we're expecting in our baseline because of this reduction in the participation rate. And when you map this onto our framework for Fed policy, what this essentially means is that the Fed would cut 4 times less than we're expecting under normal circumstances. So just to be clear for our readers here, for those of you that have been following our research, one of the big things we've been pushing is that we expect the Fed to go through a slower easing cycle than what the market is pricing, and certainly was pricing until earlier this month. But we do expect a lengthier cycle where you end up with a lower terminal rate than what the market is pricing, basically because we think that growth will slow more eventually, particularly after the second half of 25. So our baseline is for a terminal rate of around 2%. With 4 less cuts, that basically means a terminal rate of about 3, which is roughly the neutral rate that the Fed itself believes is the case. So it would realign to the Fed's neutral rate. We would still expect them to cut, basically because we do think that the economy will slow down, that the unemployment rate will go up, that job creation will stall, and that the inflation effect will be transitory. It's just that it's going to sort of the incentive to cut aggressively will just be lower than it would be otherwise.
So that's great. And just one last comment that in 2027, we see a substantial drop in inflation because it's transitory. Right?
That's right.
So Okay, so what we're going to do, this is great, Joaquin. What I'd like to do is the day after the elections that we meet again, and we can maybe talk about, you know, how we map this out to kind of our asset allocators in the U.S. Obviously, there are a lot of implications here, and a follow-up from an asset allocation perspective would be very interesting.
Yes, in fact, ahead of the election, we're going to be releasing a piece on positioning across U.S. stocks and bonds, and then an equivalent piece on positioning across sectors.
Great.
And so we'll talk about the results for those, obviously depending on who wins on November 6th. So that's I think that should be an interesting discussion.
Great. Well, thank you so much, Joaquin. We'll talk soon.
All right. Bye, Chris. Bye-bye.